American households now carry $17.5 trillion in total household debt. This number represents more than the entire GDP of China, larger than the combined economies of Germany and Japan. Every month, 130 million Americans make minimum payments on credit cards that will never be paid off under current terms. The mathematics stopped working in 2019. The system has been running on momentum ever since. When credit card minimum payments require 47 years to eliminate principal at current interest rates, the mechanism is no longer financing consumption. It is extracting wealth from future labor. The difference between these two functions determines whether an economy grows or contracts. Consumer debt became the backbone of American economic growth after the 2008 financial crisis. As wages stagnated and asset prices soared, households bridged the gap with borrowed money. Credit cards, auto loans, and home equity lines became tools of survival rather than convenience. Banks encouraged this shift. Federal policy supported it. The economy demanded it. Between 2010 and 2022, household debt service payments as a percentage of disposable income remained artificially low, despite consistently rising debt levels. Zero interest rate policy created this dangerous illusion of affordability. Families borrowed against future income streams that inflation would later erode. Student loans, auto financing, and revolving credit became permanent fixtures of middle-class budgets. For 15 years, this arrangement appeared sustainable. Interest rates remained near zero. Home values climbed steadily. Stock markets delivered consistent returns. Households could refinance, consolidate, and extend payment terms whenever pressure mounted. The system absorbed stress by creating new forms of credit. Home equity lines of credit reached $800 billion. Personal loan originations tripled between 2015 and 2021. The financial industry rebranded debt as financial inclusion. Regulatory agencies measured success by credit availability rather than borrower outcomes. Academic research focused on expanding access while ignoring long-term payment capacity. The entire framework assumed perpetual growth in both incomes and asset values. The debt cycle operates on three fundamental assumptions. First, that household incomes will grow faster than debt service costs over time. Second, that asset values will continue rising to provide refinancing options. Third, that credit markets will remain accessible when households need to roll over existing obligations. Banks profit from this cycle by extending credit at rates above their funding costs. They securitize loans to transfer risk while maintaining fee income. Government-sponsored enterprises provide liquidity through secondary markets. Credit scoring systems determine access based on payment history rather than ability to ultimately repay principal. Credit card companies generate 63% of revenues from interest charges, not transaction fees. This business model requires customers to maintain balances indefinitely. Promotional offers, balance transfers, and payment deferrals serve to extend the debt cycle rather than resolve it. The optimal customer from the lender's perspective never pays off the principal balance. Auto financing operates on similar principles. Average loan terms extended from 60 months in 2010 to 84 months by 2023. Longer terms reduce monthly payments while increasing total interest costs. Negative equity becomes standard as depreciation outpaces principal reduction. Borrowers trade in vehicles while still owing more than market value, rolling negative equity into new loans. Households participate because alternatives have been eliminated. Real wages have declined relative to housing, healthcare, and education costs. Traditional savings accounts yield nothing after inflation. The choice becomes debt or reduced living standards. Credit cards bridge the gap between stagnant incomes and rising expenses for 40% of American families. Interest rates began rising in March 2022. The Federal Reserve increased rates from 0.25% to 5.25% in 18 months. This represented the fastest monetary tightening cycle since 1980. Credit card rates followed immediately, reaching 24% for average accounts by late 2023. Variable rate personal loans jumped to 18%. Home equity line rates exceeded 9%. Simultaneously, real household incomes declined as inflation outpaced wage growth for 24 consecutive months. Pandemic savings buffers depleted as families exhausted stimulus payments and expanded unemployment benefits. Asset values peaked and began declining in housing markets across major metropolitan areas. The three pillars supporting the debt cycle weakened simultaneously for the first time in 15 years. Refinancing options disappeared as home equity evaporated and credit standards tightened. Households could no longer extend payment terms or consolidate high-interest debt into lower-rate mortgages. Home equity extraction, which peaked at $300 billion annually in 2021, fell to $89 billion by 2024. Credit card companies eliminated promotional balance transfer offers for customers with utilization above 70%. Banks reduced credit line increases by 45% compared to previous years. Auto lenders required larger down payments and shortened maximum terms for borrowers with credit scores below 720. Credit card balances reached $1.13 trillion by mid-2024, with average household debt exceeding $8,000. Monthly payment requirements increased 40% as promotional rates expired and penalty rates activated. Delinquency rates on auto loans climbed to 7.3%, the highest level since 2010. Personal loan charge-offs reached 4.1%, exceeding pre-pandemic levels. Behavioral signals emerged in consumer spending data. Restaurant visits declined 12% year over year among households earning less than $75,000 annually. Walmart reported increased sales of store brands as customers traded down. Discretionary spending categories showed consistent month-over-month contractions. Travel bookings fell 18% among middle-income demographics. Banks began reserving larger amounts for expected credit losses. JP Morgan Chase increased credit loss provisions by 67% in the fourth quarter of 2023. Regional lenders reduced credit line extensions by 23% compared to previous years. Auto dealers reported increasing difficulty placing loans for customers with credit scores below 650. The stress appears concentrated among households earning $40,000 to $100,000 annually, too wealthy for government assistance programs, too indebted for traditional financial flexibility. These families represent 38% of total consumer debt balances while comprising 32% of households. Their default rates determine system-wide stability. Credit utilization ratios exceeded 90% for 23 million cardholders by late 2024. These accounts generate maximum fee income for banks, but represent maximum risk for borrowers. Once utilization approaches limits, access to additional credit disappears precisely when financial stress peaks. Subprime auto loan originations fell 34% year over year as lenders tightened standards. Buy here, pay here dealers, serving customers with credit scores below 550, reported inventory levels 67% higher than seasonal norms. Used car prices declined 8% nationally, but remained 23% above pre-pandemic levels, trapping borrowers in negative equity positions. Medical debt contributed to 23% of consumer bankruptcy filings in 2024, representing a significant systemic risk. Healthcare costs increased 6.8% annually, while employer insurance contributions declined in real terms. Families with high deductible health plans faced effective healthcare rationing as discretionary medical spending became unaffordable. Financial institutions with heavy consumer lending exposure face margin compression as default rates rise. Regional banks holding auto loan portfolios show particular vulnerability. Fifth Third Bank, Regions. Financial and Ally Financial reported declining net interest margins as charge-offs accelerated. Credit card companies will recover some losses through higher rates on performing accounts, creating additional pressure on remaining borrowers. Households entering default will lose access to credit markets for 7 to 10 years. This group will reduce consumption to cash available levels, creating deflationary pressure in sectors dependent on financed purchases. Auto sales, home improvement, and discretionary services will contract first. Industries with average ticket prices above $500 face immediate demand destruction. State and local governments will experience reduced tax revenues as consumer spending declines and property values adjust downward. Sales tax collections, which fund 23% of state budgets, will decline faster than income tax revenues. Unemployment insurance claims will increase as highly leveraged households reduce work flexibility and geographic mobility. The Federal Reserve faces an impossible choice. Lowering rates to assist borrowers would reignite inflation in energy and food prices. Maintaining current rates accelerates the debt cycle collapse. Either path produces different forms of economic contraction. The central bank cannot simultaneously support asset prices and reduce debt service costs without destroying currency stability. Labor markets will reflect this constraint as employers reduce headcount to maintain profit margins. Highly leveraged workers cannot negotiate for higher wages or leave unsatisfactory positions. This reduces labor mobility and wage growth precisely when households need increased income to service existing debt obligations. Small businesses dependent on consumer discretionary spending will face immediate pressure. Restaurants operating on 3 to 5% profit margins cannot absorb reduced customer frequency. Retail establishments in strip malls and shopping centers will experience tenant turnover as lease obligations become unsustainable relative to declining revenues. Housing markets will experience secondary effects as mortgage applications decline 28% year over year. First-time buyers, typically carrying student loans and credit card debt, represent 31% of historical purchase activity. Their absence from the market will pressure home values in entry-level price segments, affecting homeowner equity calculations and refinancing options. The geographic concentration of highly leveraged households will determine regional economic impacts. Metropolitan areas with high cost of living and elevated debt-to-income ratios face disproportionate adjustment pressure. Phoenix, Las Vegas, and Miami show particular vulnerability based on household leverage metrics and employment concentration in discretionary sectors. The American consumer debt cycle required continuous expansion to remain stable. That expansion has ended. The mathematics of compound interest now works against 80 million households carrying balances they cannot reduce under current payment terms. Interest costs exceed principal reduction for revolving credit accounts totaling $847 billion. No policy mechanism exists to restore the previous equilibrium without creating larger distortions elsewhere in the financial system. Debt forgiveness programs would punish savers and responsible borrowers while rewarding speculation. Interest rate suppression would reignite inflation. Direct income transfers would require fiscal expansion that bond markets cannot absorb without currency devaluation. The cycle will resolve through default, deflation, or currency debasement. The choice belongs to policymakers who understand that all available options carry substantial systemic costs. Each path redistributes wealth differently while maintaining the mathematical impossibility of infinite debt expansion on finite income streams. The question is not whether this debt cycle ends, but how quickly the resolution unfolds and which institutions survive the inevitable transition. The households carrying completely unsustainable debt loads will determine the answer through their individual decisions to continue payments or seek bankruptcy protection. Their collective choices will reshape American consumption patterns for the next full decade completely and permanently today. Mathematics remains utterly and completely indifferent to all political preferences and economic theory across global markets.